Thanks for clicking. Further interest rate hikes are warranted. This was the message coming from Bank of Canada Governor Tiff Macklem at a speech given Thursday to the Halifax Chamber of Commerce. The speech sent Canada's bond yields rising to their highest point this year, and mortgage rates shot up soon thereafter.
What are you going to do?
While last month's cooler-than-expected inflation led some to predict the Bank of Canada would be slowing down on the pace of their interest rate hikes, Thursday's speech doesn't show a central bank that is bracing for a pivot. So what I want to do today is go over Governor Macklem's speech discussing where we are and how we got here, take a look at what the Bank of Canada wants to see before it can slow down the path of interest rate hikes, and then discuss what to look for next. Following the governor's speech, the markets began to expect a 50 or 75 basis point rate hike at the bank's next meeting on October 26th. We'll obviously have an update out on that rate announcement on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into the governor's speech. Governor Macklem begins his speech by admitting that the Bank of Canada obviously erred in its assumption that inflation would be transitory.
A year ago, we expected inflation in goods prices to moderate as public health restrictions were eased, production ramped up, and investment in global supply chain logistics picked up. In hindsight, that turned out to be overly optimistic.
So the Bank of Canada didn't increase interest rates at this point in time, as it thought that once the COVID restrictions were removed, that prices would ease, that supply pressures would get better.
You were wrong.
This did not happen, and the pent-up demand that grew throughout the pandemic restrictions was unleashed once all those restrictions were removed.
When the economy fully reopened in the spring, pent-up demand for all the services we've missed over the pandemic started to drive up their prices, especially in areas like travel and recreation.
We also saw food and energy prices rise dramatically, due in large part to the Russian invasion of Ukraine.
The unprovoked Russian invasion of Ukraine in February drove up the prices of commodities further, particularly oil and the prices of agricultural commodities.
And then, as such, inflation went sky high.
With further increases in good prices in 2022 and a rapid rise in service prices, total CPI inflation rose sharply, reaching 8.1% in June.
So the bank was slow to raise rates and didn't foresee the Russian invasion of Ukraine, and now we're sitting with a 7% inflation rate and a 3.25% policy rate. But where do we go from here? Well, Governor Macklem acknowledges that some global supply pressures are starting to ease. He readily admits that the Bank of Canada can't control global supply pressures.
Predicting international price movements isn't easy, and the global inflation picture could change quickly. Unfortunately, we don't have much influence over that.
However, as Governor Macklem has said in other speeches, the bank is going to control what it can control, and that is monetary policy.
What we can do is we can use monetary policy to influence the balance between demand and supply in our economy.
So, the Bank of Canada can't control global shocks, they can't control energy prices, but they can control demand. They can control domestic demand, meaning interest rates.
And they can get very, very expensive.
And their guideposts, their signals for whether or not to raise or lower interest rates, will be core inflation and inflation expectations.
Measures of core or underlying inflation and measures of inflation expectations. These are critical guideposts for us as we seek to bring total CPI inflation all the way back to the 2% target.
By core inflation, Governor Macklem means inflation that doesn't include prices of highly volatile items, like food and gas, which don't reflect broader inflationary pressures.
Core inflation provides a sense of the underlying trend in total CPI inflation, and it relates more closely to the balance between demand and supply in the economy.
So the bank isn't going to be looking at headline inflation, the inflation numbers that you and I see at the front of the Globe and Mail. Rather, they're going to be looking at core inflation, the inflation rate that doesn't include more volatile items, that doesn't include gas, food, or other prices which fluctuate widely. But it is going to be looking at inflationary expectations, whether or not Canadians think prices are going to continue to rise.
We're also closely watching inflation expectations. Keeping longer-term inflation expectations of inflation well anchored is paramount, so that as inflationary pressures ease, inflation returns all the way to the 2% target.
So the Bank of Canada will be looking at surveys of inflationary expectations and other market measurements, engaging whether or not Canadians think inflation will continue.
A range of surveys and market-based measures to assess expectations of future inflation.
So when you get those surveys, when you get those phone calls asking what you think of the Canadian economy, the Bank of Canada is paying close attention to see where Canadians think the inflation rate is heading.
Don't lie to me.
And the most recent results of the surveys that the Bank of Canada has seen show that Canadians are increasingly uncertain about the path of inflation.
In our surveys, what we see is that both households and businesses view inflation pressures as mostly global, but increasingly they are identifying domestic factors, which is very similar to our own analysis.
And as such, and although this part was said in French, so we don't have a clip of it, the Bank of Canada says more is to be done. More interest rate hikes are coming. So, according to the Bank of Canada, inflation is still far too high. The measures of core inflation are still far too high for Governor Macklem's liking, and as such, they are going to be raising interest rates. As a result of the speech, Canada's bond yields rose to their highest point since 2007, with traders firming up their bets that we would be seeing at least a 50 basis point rate hike at the Bank of Canada's announcement on October 26th. And we're hearing very much the same type of rhetoric out of the Federal Reserve, that inflation is too high and to expect more rate hikes. While the UN is calling on the Federal Reserve and the rest of the central banks to slow down, to pause on rate hikes for fears of a global recession, there has been very little indication that the central banks are going to listen. So, interest rates are going up, mortgage rates are following, and now many are predicting that we're going to be seeing a 4.25% terminal rate, meaning rates will be going as high as 4.25 or 100 basis points higher than they are now before the Bank of Canada stops raising rates. So, all in all, the bank admits it was wrong on transitory. It is going to be continuing to raise rates. More rate hikes are needed. And it's not going to stop until it sees measures of core inflation slow down substantially, and until it sees inflationary expectations slow down as well. Until it sees that Canadians understand that we'll be getting the inflation rate under control, and that prices will stop rising so fast in the future. And as we've said on this channel before, the central banks, the Bank of Canada, the U.S. Federal Reserve, are number one concerned with avoiding hyperinflation, with avoiding the complete debasement of our currency, and are going to continue these rate hikes until the data says that they don't have to, until the data says inflation is coming down. The rate of our price increases is slowing and slowing substantially. We'll obviously continue to have an update out on the Bank of Canada's announcements, the Bank of Canada's rates on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.